Good morning. Welcome to Good to Know Talk series, where our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. With us this morning is James Kong. James is a financial advisor at Edward Jones. He works with small businesses, individuals, and families to identify their risk and develop strategies to help them reach their goals. And he's my trusted source in the industry. Good morning, James.
Good morning. Hey, how are you?
I'm good. We had a little bit of a technical delay, so sorry to keep everybody waiting.
No worries.
I'm excited to hear what you're going to be sharing with us this morning.
Yeah, I'm just going to go over, it's going to be a two-part series. Today I'm going to go over some considerations and what people are kind of looking at the cost of waiting when it comes to saving for education. So it should be, about 10-15 minutes looking at the numbers. And then next week we'll be looking at different investment vehicles that can help to try to prepare for education costs down the road. So I shared my screen. Can you see it?
Yep. Yeah, we can see it.
Okay. So I'll hop into it just so I can get everyone out of here in a timely fashion. So, when really looking at the numbers, and that's what I do, as a financial advisor, is just helping people educate themselves on what's the cost of saving. So, a statistic that I found showed that 75% of high school seniors are accepted to their college of their first choice, but less than 57% can actually afford to attend that college. Okay. This statistic was pretty staggering. Americans owe more than 875 billion in student loans, and that's more than our nation's credit card debt. And then for those of you that, may have daughter, granddaughter, that's going to be the next Carrie Walsh or Misty May, statistics show that only 0.3% of all students will actually earn a full ride scholarship, whether it's athletic, academic, or any other type of scholarship. If you look at the numbers, again, comparing 30 years ago, tuition is about 400 times more expensive if you were to go to college today. The average cost of a four-year private school is $143,000, and an in-state public school averages about $42,000. And then lastly, in 2015, 2016, statistics showed that undergraduates received about 55% of their financial aid in the form of grants. 36% was funded from loans, and 9% was a combination of tax credits and then work-study programs. So just as I mentioned, looking at the rising costs of college, and this is for private institutions, so that anyone who is planning to have any kids relatively soon, let's just say it's a newborn, that when they're 18, the cost of schooling at a four-year private college will be on average about $314,000. So when I was at Pepperdine back in 2000, the total costs are about $140,000 for 4 years at college, and this is what it would be looking at today. So when we add in public college, and then I looked at the statistics for Manoa. Manoa's tuition this year was about $11,162. So if we multiply that, we get about this national average range if we were to go send any kids, nieces, nephews to Manoa. And so people say, hold up, James, let's not even talk about college. Let's talk about possibly, getting my kids into either elementary, middle, or private high school. And so there's no bias here, but these were the figures that I knew. And the first one is if you were to go to Kamehameha schools, that when I was there in 2000, tuition was $2,500 roughly. If you look at tuition costs today, it's about $5,381. And if we fast forward 18 years from now, at that increase, we're looking at about 11,500 in 2036. Okay. My rival high school, Punahou, back in 2000, tuition was $10,942. Today, tuition is $20,850. And then if we fast forward 18 years from now, we're looking at tuition being roughly $51,772 based on the average increase year over year. Okay. And then lastly, Hawaii Preparatory Academy, if you're a boarding student, I couldn't find the figures for 2000, but today for a boarder, it's $50,900. And at that rate of return for education, it's usually around 5 to 6% increase year over year. We're looking at 110,500 18 years from now. So, when people really identify a good strategy, they kind of nip it in the butt right from the get-go. It's all about planning and budgeting, saving, and investing. So I show this chart to a lot of my clients to urge them to save sooner than later. And so in this case scenario, it shows over three different, a time span of 3 years differing between, each time in which you'd want to start saving for a child. So that if you started saving when they turned 1, and this is $200 per month at a 7% rate of return, you would have saved about $86,000 by the time they were ready for college. And this shows that if we were to delay any type of, savings, that, what the cost of waiting would be. Okay. So you can see that there's a very big discrepancy or spread that if you start saving later in that child's life versus sooner. Okay. And then again, failing to plan is planning to fail. So when we look at, James, what's the best way for me to fund it? And a quick answer to that is, let's not borrow any money or have to take out student loans. I have a lot of clients, friends that are still in deep debt with student loans, and it just really comes down to planning in advance. So I like to show this example so that if we were to put aside $24,200 per month for 10 years, and with market fluctuations and an average rate of return of 7%, we'd accumulate $11,000 worth of earnings and have been able to save $35,000. Again, the total cost was $200 per month for 10 years. Okay, let's say if we didn't budget and save, the $35,000 in which you would need to take out a loan, and student loan rates are around 6.8% today, rather than earnings, you're going to accrue interest that you're going to have to pay for those student loans. So on top of that, we're looking at about $400 per month if we fail to put together a plan or a strategy. This is significant in terms of getting your money to work for you in the saving side versus you having to work for your money and then pay someone else interest to borrow money. So whether you decide to sit in your savings account to save for college or invest it in the market, you'll always take on some type of risk. Okay. The first risk that I'll discuss with people is market risk. So whatever they put aside, $10,000 for little James Jr., the money invested will ebb and flow with the market based on fluctuations of the market. so nothing's guaranteed. So the cons of this is there's no guarantee of principal, but the wider the time frame, the more potential to either outpace inflation or, in this specific scenario, education savings risk. Again, that number that you want to try to focus on year over year is about 5 to 6%, in which tuition costs rise year over year. The next type of risk is principal risk. Is my money safe and is my principal protected? So a lot of people, young families that, don't really know how to invest. They say, James, I've opened up an account for James Jr. We're putting in $200 per month. It's earning 0.02% interest. It's not going to keep up with the rising costs of education. So again, that number is 5 to 6%. So again, at 0.02% that you're earning in your savings and the rising cost of tuition or education is 5 to 6%, you are losing pace and not maintaining your purchasing power. The pros for this scenario is maybe when that high school graduate or as a junior in high school, maybe shift into a savings account, because then you're more concerned about principal protection as the time to enter college is coming closer and closer.
James, we have a question from the audience. Tasha asks, what's a common mistake which you see parents make when saving for college? That I would.
Yeah, I'd say, a common mistake is, again, not looking at education savings risk. So really diving into the numbers and seeing what it costs for education today, and then look back to see what it may cost at Manoa in 2015, 2010, so on and so forth. So again, it's really understanding what type of risk they should be taking on. And again, if it's a newborn or an infant, we want to take on some market risk based on a low interest rate environment. But if it's someone in their latter stages of high school, you may want to shift to a more conservative principal protection strategy, in which if there is a market pullback, then they won't see significant losses as they get closer and closer to entering into college. So great question. Yeah. Any other questions?
We have another one from Victoria. Before I get to that, I had a question. With what the market has done just in the past few days, should people be concerned about, their current, their child's education savings account?
Yeah, great question. So if whether it's a 529, a custodial account, a cash value life insurance policy, whatever it may be, if it is managed properly, there shouldn't be any type of risk. And it's all going to be based on that student's age. So if that student is 17, 18 years old, the portfolio should have been managed in a way that you're taking on less market risk because you're getting closer to that college entry date. If there's an infant or someone maybe in elementary school, today is a great time to get into the market at a discounted price, since the market's come down in the last few days. So for those clients that, are pretty active and understand the ebbs and flows in the market, when their market's down and it's at a discount, it's even cheaper time to get into the market. So great question.
And Tasha just asked, so is there a point where it's too late to start saving?
Yeah, I don't think there's necessarily a point that's too late, but again, as as that future student gets closer and closer to 18 years old and is going to be entering into college, we just need to understand that with current savings interest at 0.02%, even if you were to move into a CD that was offering you 1.6%, you're obviously not keeping up with the 5 or 6% increase that you need to year over year, but at least you're making up that gap somewhat. So my job as an advisor is really to educate people on what's the best strategy to reduce that gap again between what we're earning in interest at the bank versus what our money needs to earn just to get the exact same education you could get today, 5, 10, 18 years down the road. All great questions. Any other questions?
Yeah, getting back to Victoria's question, have there been any changes to the college savings account since the new tax law?
Yeah, there's been one significant change that I think are going to benefit all those that have established 529 plans. And the new ruling um, says that you can use up to 10,000 from a 529 to fund K through 12 education qualified expenses. So some of my clients and some investors out there didn't really consider or didn't like that 529 plans were strictly for college savings. And now it's been a little bit more liquid or flexible in that, again, you can tap into up to 10,000 from a 529 per student for K through 12 expenses.
And that's per year, you said?
Per
10,000 per
year,
student
correct.
per year.
Yeah. And so then just a couple more slides to wrap things up. Again, managing your risk. We talk about education risk, which is similar to inflation risk. Will my money today get my child the same education when they're 18 years old? That's the question that people have to ask themselves. And then there needs to be a plan to keep up with that 5 to 6% increase. And so as I mentioned before, based on time frame, your market and principal risk should be adjusted by whoever's helping you with your college savings account. So in that scenario I gave earlier, if you're a newborn infant, you can take on some market risk to try to outpace education risk. And then if you're a high school student, it's almost the complete opposite, that your main concern should be principal protection. So at this point, everyone's saying, we're thinking, we're doomed, James. We're going to have to go to community college, or they're just going to have to go straight into the workforce. But that's not necessarily the case. The first step is really helping people to budget and save. So on a monthly basis, you want to determine what's coming in from income and what's going out in the form of expenses. And with that surplus amount, whether it's $50, $200, or $2,000, you put aside in the education savings account. I'm going to get into more detail next week on what type of accounts you can utilize. But yeah, we'll discuss that in detail next week. And so you want to initiate an automatic monthly deposit so that money is out of sight, out of mind. And an app that I use to kind of help organize my income and my expenses and my cash flow is mint.com. So I'd highly recommend for those looking to get a better handle of their budget to utilize that app. And the second step is, how do we save? Okay, saving is different from investing. When you save money, you're building a cash reserve, and it's going to act as your rainy day fund. So you want to make sure to keep at least 3 to 6 months worth of expenses, so that if you're temporarily sick or injured, that you don't skip a beat and you can easily move funds from your bank account to supplement any loss of income. Okay. So principal protection is a primary objective when it comes to short-term needs, but you need to realize anything in excess of that 3 to 6 month rainy day fund needs to be invested to reduce your inflation risk, or in this case, your education savings risk. And then the last step is, now you can qualify to invest. So anything in the near term, 1 to 5 years, principal protection is probably going to be the primary objective. In a 5 to 10 year time frame when saving for education, you're probably just looking to maintain your purchasing power. And then in 10 or more years, so infant or elementary phases of that that future student, you're looking to increase your purchasing power or have your money working for you. So again, if your investment returns are in excess of 5 to 6%, your money is now working for you and you not working for your money, or potentially having to borrow someone else's money. Okay. And just to wrap things up, the cost of waiting, really determine and structure a budget plan that on a monthly basis that you can put aside money to start saving for education. Develop that budget, so you can utilize that surplus to reduce your education savings risk, and then find the best strategy for you. If you tune in next week, we'll be looking at different types of vehicles in which you can save for education, and then also consult with Janine to look at tax considerations, also liquidity concerns, and then also financial aid considerations. So like I mentioned, in our next episode, we're going to go over different types of saving strategies like Coverdale accounts, custodial accounts, 529 accounts, and then also what I see is becoming more popular with parents and their children are cash value life insurance policies, because they could be a little bit more flexible in terms of how you can tap into them and when you can tap into them. If you have any questions or want to review your current strategy, especially based on what the market's done in the last few days, please feel free to reach out to me. I'm more than happy to give you a second opinion and see if there's any good buying opportunities since the market has come down. But at this time, Janine, if you want to open it up for any additional questions, or if I've pretty much addressed everything, then
Yeah, I think you got everybody's questions. That's great information, James. Thank you.
Yep.
And actually, you're right on time. We are at the end of our time today. You can always reach out to James, at his email here, james.ka@edwardjones.com. And you can always email us at info@smarttaxhawaii.com if you want any of this information, or if you want to get in contact with James. Thank you for joining us this week. We look forward to next week. Thank you again, James, for the valuable information. And
yeah, no worries. And I look forward to touching base with everyone next week.
Yeah, thank you. Have a great week, everyone.
Okay, take care.